Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, I'm Paul Winkler, talking money and investing. Okay, so we're talking a little bit about confidence, and things that I've talked about here on the show is I want to educate and do it from I've always taken a more of an evidence-based approach to education here on the show. The idea being, what has the research shown that like guys like Fama and French and Singfeld and these people that have done research looking at markets and going, okay, so this works in the United States. Does it work over in Germany? Does it work in, Great Britain? Is the multi-factor type of investing research that we've been doing, is it something that we also see showing up in the data in Australia? How about Japan? And that tends to give you confidence when you see that it's not only something that happens here, but it happens everywhere. So that's one of the things that I find that helps with confidence. Now, the other thing is that I like to give examples of what not to do here on the show. Because I think if you hear what not to do, then you're more wary of the messages that you get out there in the media and in the marketplace when you watch the programs and when you see these people from different investment companies being interviewed. You get the red flags. And sometimes people will hear me talk about annuities and go, and this is really kind of, there are a couple of places that annuities make sense, but very, very limited circumstances. But you'll see them marketed to just about everybody. You go into a bank, it's one of the first things they bring up. You go to an investment firm, you see these different investment companies that do radio shows all over the place. And quite frankly, that is what they're often doing. They're maybe leading with talking about stock markets and those types of things. But in there, they've got annuity sales almost always. I mean, it's just a proverb. It's almost so common. Now, one of the things that when you invest, you always have a custodian. The reason that Bernie Madoff got away with what he did was that you made checks payable to Bernie Madoff. It's a really bad idea. You don't want to do that. But that's what happened there. Now, a custodian is the group that actually physically does the trading in the investment portfolio, or they do the tax report and they do the tax reporting. Whenever you buy a mutual fund, I don't care who it's with, American funds, it could be Vanguard, it could be Fidelity, it could be, T. Rowe Price, it could be whoever. You will have a custodian that actually does those trades inside the mutual fund. It's part of the structure. Now, this week there was an interview of one of the bigger investment firms out there, and we work with them. And now I don't have any problem with the firm. I have a problem with the investment strategy that's being talked about, though. And like I said, I want to make sure you're aware. Just because a custodian is doing an investment strategy that is not necessarily the greatest, in my humble opinion, it doesn't mean that you can't work with the company, that they don't do, that the service that they provide isn't usable. So I just want to make that clear right there. So in this particular instance, Rick Wurster of Schwab is talking about the approach to investing and what's going on at the company. So just check this out.
What are the hardest things about what you're working with right now, though? With competition that's tough up there. Right now, you've got the market going in your favor with all of the new highs that we've been hitting. How much is that at risk if you get into some trouble, if you have these lower days, higher volatility days?
Now, so the idea here being that everybody's a genius in a bull market. When markets are going up, everybody feels really great and they feel that they've got this down, and they don't, they don't have anything to worry about. And I'm like, recognize that markets do go up and go down. And a lot of people will jump into firms like this and they will do their trading and they'll set up platforms and they'll buy mutual funds and do things like that. And they feel like, I can't do anything wrong. Everything's going up. There's nothing to worry about. But she's saying, well, wait a minute. While everything's going well, that's one thing. What if things turn around?
What happens? You said you get calls from all these people. What are they asking about right now?
Yeah, we have 46 million client accounts, so we see a range of behaviors. We have a lot of active traders. Those active traders, they've been buying dips selling the rips, actually.
Okay, so great. Here we go. And we love it when you guys just want to buy the dips and buy the rips and you do all, and we'll let you do that. We're basically kiddingly saying you're like a drug dealer. We'll give you whatever you want, and that's it. We'll enable you. It's like having a kid that says, I want to go do this. I want to go do this. I want to go drive your car 100 miles per hour. I want to go drinking on the weekend with my friends. I want to do it. And you go, oh, as a parent, you go, oh, yeah, that's great. That's great, Johnny. Go ahead. You drive the car at 100 miles per hour. Oh, yeah, you go and go out, get stone drunk on the weekend. Yeah. And while you're at it, why don't you smoke a little pot or something like that? And if you're an enabler like that, you're going to end up with a kid that ends up in a wreck and ends up probably killing somebody. I mean, it's not good. But that's basically what happens. We're enabling investors to do whatever you want to do. If you want to do that, go ahead and do that. But that's not the only type of investor. Some people have been burnt so many times, they don't necessarily do that. Now, how are you handling these people?
And we have a lot of long-term investors who, when they call, we talk to them about diversification. We talk to them about not timing the market, but time in the market.
Yeah, why don't you talk to everybody about that? Not timing the market, but time in the market. Now that sounds like a nice little cliche, and it is a good little cliche. Now you're not going to time the market. You're not going to try to figure out what's going to go up and what's going to go down. We want to make sure that you're invested, in a lot of different places, but you don't buy and sell and buy and sell. You want to buy and hang on. That's the external message, but keep listening. Check this out.
One of the interesting things we've been talking to our clients about more recently is that the S&P is as concentrated as it's ever been.
Does that concern you?
Well, we want to talk to our clients about the power of diversification. The top 10 stocks in the S&P today are 38% of the index. That's more.
So as I've said here on the show, a lot of people have, the Vanguard had actually their projection at the end of 2024 as what would be the worst performing area of the market going forward for the next 10 years. And it was large U.S. growth stocks was where they were saying. And number one, you think about that in the first place, that's them basically timing the market. Because why would I own any of those stocks if it's going to be the worst performing area going forward? So recognize that anytime somebody's making a projection like that, it is a subtle form of encouraging market timing. Because they're making a prediction about the future. That's what it is by definition. Market timing is making a prediction about the future. And they're basically doing that. Was what the Vanguard was doing. Now, what did they say would have the worst performance? As I said, large growth stocks. If you look at, take all the assets under management at the fund company and look at where the money is, the vast majority of it is in that area of the market with the worst expected, according to them, future return. And what does that tell you? I'll just let you draw your own conclusions regarding that they would make a prediction like that and then still have most of their clients' money in that area of the market. I'm just saying, right?
Double where it was 10 or 15 years ago. And so the benefits of diversification and thinking about your portfolio are as important as they've ever been. And
well, it's probably something you should have done a long time ago, but now at least they're talking about it anyway, right?
And those are the kinds of things that we're talking to our clients about every day and trying to help them because we're in the outcomes business. We're trying to help our clients achieve their financial goals.
Diversification into what, I guess, becomes the question.
That's not a bad question right there, Becky. Diversification into what? What are we going to diversify? Because diversification is an overused term. I can diversify into, 18 different funds that own the same stocks and I'm not diversified. I just think I am diversified. But anyway.
Financial goals.
Diversification into what, I guess, becomes the question.
Well, you can buy, a broader variety of indices, different stocks, bonds.
Now, the issue there, of course, as I've talked about here, is that indexing works really well with large U.S. stocks and large international stocks. It doesn't work as well in other areas of the market. But anyway, you could do that. You could buy into these other areas, is what he's saying.
They're actually cool again with rates coming down. Clients,
let me back that up.
Broader variety of indices, different stocks, bonds. Bonds are actually cool again with rates coming down. Clients are more interested in actually owning bonds versus.
So that may just like right over your head, but he said bonds are cool again. Now, cash is when you just have money like in a CD or like more likely like a money market account or a savings account or something like that, or you have it in your lockbox at your house or whatever, cash. But bonds are when you lend for a longer period of time. So let's say that if I have a 10-year bond, I give them $1,000, they're going to pay me interest only for the next 10 years. And then in 10 years, they're going to give me my $1,000 back. So if it's a 4% bond, they're going to pay $40 a year, every year. And then in 10 years, I get my $1,000 back. Or if it's a 5-year bond and it pays 3%, you're going to give them $1,000 and they're going to pay you $30 a year for the next 5 years. And then at the end of 5 years, you're going to get your $1,000 back. That's what a bond basically is. Now, what he's saying there is they're cool again, quote unquote. Now, why would they be cool? Well, what is it I said earlier that investors buy? They buy based on past performance, historical performance, what is in the past, in the rear view mirror. Now, when interest rates go down, bond prices go up. So what is he basically talking about here is that because investors have just seen interest rates come down, which has driven bond prices up, they have seen good past performance, and now they are attracted to the asset category because the return has been higher in the past. What are they doing? Buying based on rear view mirror investing principles, based on past performance. When did you want to own them? Before they were cool. Now he's saying they're cool. And what are we going to do? If you want it, we'll give it to you. That's basically what the deal is here.
Is being in cash. So we're talking to clients about a variety of asset classes.
Yeah, so, a variety of, we got some cash. You might have some cash, put some money on the sidelines like that. Now, let's get a little deeper about what might be recommended. Let me do this. I'm going to take a quick break, and I'm going to come right back, and we'll talk a little bit more about what they're helping people invest in. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on... Well, I'm back here anyway. I'm Paul Winkler. This is the Investor Coaching Show. PaulWinkler.com is the website if you want to learn more about what we do. I'd certainly encourage it because I just quite frankly think it's the way to do things. If you haven't figured that out. I'm pretty convinced that this is the right way to do stuff. And with good reason. So anyway, we're talking about, the investment firms, sometimes we just got to look at what you shouldn't be doing to figure out what you should be doing. And I want you to be able to recognize when maybe an investment firm is trying to get you to do something that you might not want to be doing. Okay, so the conversation was, what are we hearing at this big investment firm? What do we hear? What are people asking about? What are they calling about? Well, they're calling about, diversifying their portfolios. They've got these big gains, and they want to know what to do. And they've done maybe their portfolios are up for the year, but they're going, oh man, I'm a little bit nervous. I'm hearing that the market could be headed for a crash, and you don't know that. That's basically a prediction about the future. You don't know. Alan Greenspan basically said that in 1996. Oh, it's irrational exuberance, and the market went up in 1996, 1997, 1998, and 1999. And, if you had backed out, if you had jumped out, you would have missed all of that upturn. And it would have been a really bad thing. Even though the market turned down, it went up more in those years than it went down afterwards. So it's just a bad idea to try to predict these things. Now, what, in essence, is he saying that people are looking at? Well, this is it.
You're adding new things, too. I think crypto ETFs are on the lineup, and you're looking to private assets.
Oh, that's good. Crypto.
Yes, we've been active in both. So in crypto, we do offer crypto ETFs, Bitcoin futures, closed-end funds.
Yeah, catch that, Bitcoin futures. If it wasn't bad enough that they want to go gamble in Bitcoin, we want to add another aspect of gambling to make them futures contracts. So let's make this even more fun. It's this is a blast. We'll let you do whatever you want to do. We're enablers around here.
In fact, our clients own 20% of all the crypto exchange traded products in our country. So they've been very active. We've seen visits to our crypto site go up 90% in the last year. It's a topic that's of high engagement. And for privates, we have made private investments available to our clients.
Yeah,
we've done through
there we go.
Let's
a little bit of private equity. Well, let's do that. And I've talked about that in the show here, and go, good grief, whatever you want to do, we'll give it to you. Sometimes it's just okay to say no. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.